Celsius Holdings recently reported its Q1 2024 earnings, triggering a volatile stock price swing. The stock went on a rollercoaster ride by going up 25% after the earnings and then dropping 35% in the last few weeks. In this video, we will analyze Celsius Holdings in two parts. Part 1, most recent earnings breakdown. We'll dissect Celsius' latest financial statements using my own custom-built spreadsheet. This will highlight key data from the income statement, balance sheet, and cash flow statement. Then we will explore various valuation methods, including discounted cash flow analysis, to determine if Celsius is currently undervalued, fairly valued, or overvalued. Part 2, holistic company evaluation. To gain a comprehensive understanding of Celsius's business, we'll utilize a custom scorecard I developed for valuing businesses. This will involve going through a checklist and answering a series of criteria questions designed to evaluate the moat, profitability, leadership, and the story of the business. Part 1, most recent earnings breakdown. If we look at the income statement, we can see that revenue went up year over year by 37%. We can also see that the net income went up 101% year over year. Net margin currently sits at 18%, and the shares outstanding increased by 0.5% year over year. The earnings per share year over year went up by 100%. The reason why the earnings per share went up slower than the net income is because of share dilution, so this 0.5% here. EPS compound annual growth rate for Celsius for the last 5 years has been 123%. Next, we look at the balance sheet and we see that the cash went up by 17% year over year and it's currently sitting at 0.9 billion. The debt went up by 27% and is currently sitting at 0.2 billion. Then we look at the cash flow statement and we see that the free cash flow went up by over 1,000% year over year. This is because Celsius reached free cash flow profitability only recently. The free cash flow margin sits at 31% at the moment, and the free cash flow per share went up by 1,024% year over year. Again, the reason why the free cash flow per share went up slower than the free cash flow is due to share dilution. We also see that the stock-based compensation is very low, sitting at 20 million. The free cash flow per share compounded annual growth rate for the last 5 years is at 270%. We will skip the valuation for the moment because we will look at it later in a visual way, and we will go over some notes I made while going over the earnings. I noted that Celsius has a very high revenue growth. It recently reached profitability in the last 3-4 quarters. It is also barely expanding internationally, so it's only in a couple of countries outside the US, and therefore has a long runway for growth. And the analyst projection for the next 5 years is 30% revenue and 28% EPS per year. I also looked at where does the stock price appreciation come from, and I saw that over the last 5 years the stock price went up 157%. However, the free cash flow per share went up by 270%, and the price ratio contracted and went down by 30%. This means that the intrinsic value of this business is going up faster than the stock price. Then I went and calculated the intrinsic value for Celsius. I took the 270 million in the free cash flow, applied a 50 price ratio with the free cash flow compound annual growth rate of 20%, and I assumed a 6% shared outstanding increase, which is 9% difference to the stock price after the earnings, which was 71 euros. So at that time, in my opinion, Celsius was overvalued. However, after the roller coaster that Celsius went on and the stock price went down to 55 euros, it presented about a 50% difference to the current stock price, and I decided to buy some shares. Now, let's look at the valuation and the price ratios. Current PE is 85, the price to free cash flow is at 68, the price to free cash flow adjusted for stock-based compensation is 73, that means there is very little stock-based compensation going on, and the enterprise value to free cash flow is 65. EV to free cash flow is my favorite price ratio because the enterprise value factors out the cash and debt that a business has. We can see here that Celsius has a higher cash pile than debt, and therefore the enterprise value is lower than the market cap. Meaning, if you were to buy the whole business, the enterprise value you would be paying is lower than the market cap. Now, let's look at the part 2, holistic company valuation. As you can see, this is my checklist for assessment of companies. First, I look at the moat, and I rate that Celsius has a partial moat because it is managing to grow very fast. However, it is still not that proven, and it will take some time to prove it. In my opinion, Celsius is a nice alternative to the unhealthy energy drinks out there. Next criteria is revenue and margins. Revenue has been going up by almost 100% over the last couple of years, and the last year it went up by 37%. Net margin was negative over the last few years, but the latest net margin is at 15%. Free cash flow margin was also on average non-existent, but the latest free cash flow margin is at 90%, and therefore I rate the revenue as excellent and margins as very good. Next one is profitability. The earnings per share and the EPS are growing very fast. The free cash flow and the free cash flow per share are also growing very, very fast, and therefore I think the profitability is excellent. Next one is debt. This company has only 0.2 billion in debt. The current ratio is 3.9, which means that they have more cash than liabilities, as we saw. Next one is return to shareholders. I look at this as dividends, share dilutions, and stock-based compensation and free cash flow. The company doesn't pay any dividends. The shares outstanding have grown by 6%, and the free cash flow yield, excluding stock-based compensation, is at 1.4%, where the stock-based compensation is only 0.1% from the free cash flow. Next thing is valuation. At the moment I did my analysis, I thought the company is overvalued because it has higher PE and higher price to free cash flow than it has right now. Over the last few years, those were in hundreds. The risk premium is not so good. The PIG ratio is also not so good, and the stock price was at all-time highs, and therefore I calculated the intrinsic value at 65 and an acceptable buying price of 60 euros. The leadership I think is excellent because the insider ownership is very high at 45%. The insiders are holding onto their shares and they have a good cost control. For example, the stock-based compensation. Last but not least is the story of the business. And this is what my favorite investor Peter Lynch always talks about. Find a story and follow that story. I think the story of Celsius is that the revenue is going up very fast. They have a high forecast. I think they have a long runway for growth when they expand into the rest of the world. I also expect contraction of price ratios as the business slows down their explosive growth. And as I said at the time, I thought the business was too expensive, but was a good candidate for my portfolio. Now that I've bought it, we will just have to wait and see if this was really a good buy or not. That was my analysis of Celsius Holdings. Now, before you run off and invest your hard-earned money, remember that this video is for informational purposes only and it does not constitute financial advice. Do yourself a favor and conduct your own research before making any investment decisions. Lastly, if you like this video, then please make sure you leave a like on it, and if you want to see more investing videos like this, then please consider subscribing to the channel. Also, don't forget to leave a comment suggesting a company that I should review next. Cheers.